Good morning. Happy Friday, Focus. Friday the 25th of June. Nearly the end of June. Anybody who is doing profit first, next Wednesday, we have our quarterly profit distribution. That means we can start taking money out of our accounts again and start buying things that we want to buy, etc., which is really exciting. Anybody who has no idea what I'm talking about, come and join us and find out what it's all about. Profit First is a massive way to manage your cash, pay yourself what you're worth, save up for your taxes so you don't have to worry about them, pay yourself what you should be paying for. I've said that already. Putting money aside for profit. So whether that's because you want to have better holidays or holidays at all, whether that's because you want to put a new kitchen into your house, whether you're saving up for a deposit for a house, it doesn't matter what it is. You can use it for whatever you want to. It's your money. But the point is that you're putting it aside every single week, and it changes people's lives, actually, is what it does. But that is not what we're here to talk about. So what do you think of my new office, everybody? Everybody says it looks very similar to my last office. Well, that's the whole point, because consistency. I wanted to have a bit of consistency to give people what they've always had before. So we've got the same colours, we've got the same plants, we've got the same shelves, sort of slightly moved around, got the same picture of the bridge that my son did, and all sorts of lovely things. So anyhow, it's a bit echoey in here at the moment. I need to get some more pictures up, I think, because it's, very echoey. Anyhow, so what are we talking about today? So it's the end of tax year for an awful lot of people, and they're thinking about doing their things. Hey, Kate. Hey, Victoria. How lovely to see you. This is what Kate has to say about Profit First. It changed my income and had such a positive impact on my business. That is unbelievable. Absolutely unbelievable. So, anybody wants to talk to me about it, come and talk to me, because I'd love to talk to you. I would talk about Profit First until I could be blue in the face. Anyhow, what we're talking about today is common tax deductions that a lot of small business owners overlook or think, do you know what, don't need that, it's not going to make that much difference. It all makes a difference. And once you start claiming for these things, then you start to do them automatically every year. Anyhow, so paying tax. Oh, God, we all hate it, don't we? We really hate it. But it is so inevitable. And actually, if you're paying tax, the more tax that you're paying, the more likely it is that you're making a good profit. So whether that's corporation tax or personal tax, it makes no difference. If you are paying tax, it's because you are making money, which is what we are all in business to do, to make money. So it's actually a good thing. So if you can save up for that tax by putting it aside every week, month, fortnight, whatever it happens to be, whatever works for you, a certain percentage into another account, out of sight, out of mind, then at least you know that by the time you've got to pay either your corporation tax or your personal tax, whatever that might be, that money's already saved up. You don't have to worry about it. It's a worry off your shoulders. And that's what we want to do, give you peace of mind. So none of us like paying tax, but the more that we can actually save and make sure that HMRC are still happy, the better, surely. Okay, so when we're starting out our business, one of the things that a lot of people miss out on is the startup expenses. Now, this is really key because the majority of us, before we start our businesses, we've got a lot of startup expenses. So that might be equipment, that might be computers, that might be products that we've got to buy, that might be marketing that we've got to pay for, that might be accounting that we've got to pay for to get some advice and things like that. The rules are different if you're a sole trader or you're a limited company, but if you are a limited company, you can claim the relevant startup expenses for up to, get this, 7 years before the business officially actually begins its operations and starts trading. Now, I don't think that there's very many people who would probably have 7 years worth of receipts for a business that they're going to start 7 years later. But if you do, you can claim it, which is great. And also, just because you've been in business for a few years doesn't necessarily mean that you've actually missed that boat. So you can actually go back and reclaim those at any time you want to. I always thought that it was 4 years. 4 years for 4 years for goods. 4 years for services, and 6 months for goods that you have still got in your possession. So that obviously doesn't mean stock that you might have already sold, but it does mean things like your computers and bits and pieces and stuff like that. So number 2 is home office expenses. Now, there are different ways of claiming these, but if you have a room in your home that functions as your primary place of business, then you may be able to claim a home office deduction. Now, that does not mean to say everybody will be able to. And there are a lot of different calculators to work out exactly. Hang on, what's Kate just saying here? I keep telling my husband to keep all receipts for his woodworking equipment in case he decides to make it a business. I've not seen one yet, but he's bought a lot. Brilliant, Kate. Yeah, I can imagine. Yeah, that sounds a bit like my husband. Receipts? What do I need receipts for? Yeah, anyhow. Home office expenses. So expenses such as gas, internet, electricity, water, percentage of your mortgage interest or your rent. I would never put through your council tax, and I'll explain why in a minute. But it all depends on what percentage that is. It depends on whether you're using that room solely for your business, or as HMRC use that particular phrase, wholly and exclusively for your business, or whether it's a shared room. So if you're using the dining room table, or you're using a spare room, which is sometimes used for people coming to stay, and sometimes it's just used for your business, depends what it happens to be, then it's a different sort of percentage. We have to work that one out. So we work out what that calculation would be depending on what your circumstances are. And obviously during this pandemic, as an awful lot more people have been working from home and having to set up a room solely for their business, because that's where they're working from and that's all there is to it. You will also be able to claim things such as office furniture. But again, you need to calculate the usage portions. So if you are using that office desk just 100% for your business, then fine, you can put the whole lot through. If you're using it part for your business and part for your personal admin, then you can't put it all through. How HMRC are going to know that, I haven't got the slightest idea. So I think that's up to you whether you want to push it through or not. That's what they say that you have to use. As far as home office expenses, there are 2 ways that you can do it. You can either calculate it yourself, depending on that percentage, or you can use HMRC's own calculations. Now, at the moment, it's working out to being, depending on how many hours you are. I think if you're working in between 50 and 100 hours, it's £26 per month. So you're not going to be getting huge amounts. If I was you, I'd work out the calculation if you can, because you're likely to get a lot more. But if ever you had an investigation, and I have to say this, if ever you had an investigation, you will need to show your receipts. So a copy of your mortgage interest, a copy of your gas bill, your electricity bill, your water bill, etc., etc. Also, if you have a cleaner in your house, and that cleaner is also cleaning your office, there is no reason why a percentage can't be put through the business as well. That's quite useful. Carryovers. This is number 3, carryovers. Business owners often overlook capital and net operating losses as tax deductions. Now, again, during the pandemic, this is really, really key. It is possible to carry those losses over into future tax years to reduce taxable income. It's a deduction that you really need to keep notice of. So if you have a loss in your 2020-21 tax year, whether you're a sole trader or your limited company, you can offset that loss against future profits. So say you had a loss of £10,000 this year when you've just done your accounts, and you're a bit sort of, oh, God, what's the point? I don't want to do this. But actually business is getting a little bit busier, so maybe I'll keep going. It does seem to be looking busier. and actually I've got nothing else, so I'm just going to keep going, whatever happens. Next year, you make a profit of 15,000, you offset that 10,000 against that 15,000. So actually your profit that you're paying tax on is only 5,000. Now, HMRC actually it's not HMRC, it's the government, are in the process of pushing through a bill. If you have a corporation tax loss this year, usually you would be able to carry it back only 1 year. So say you had a loss this year, but you paid corporation tax last year, you would be able to offset that loss, it's called a carryback loss, against that profit last year. Now, because of COVID, they are trying to push through, and it hasn't been agreed 100%, but I think it's pretty damn likely, that actually you're going to be able to offset against 3 years backwards. So say, for instance, you had a loss this year, but you paid corporation tax last year and the year before, but the loss this year, I don't know, say again, the loss is £10,000, and the profit last year, or the tax that you paid last year was £6,000, then that can be carried back for a start, but then it can be carried back to the previous year as well. Now, we're only going to probably be able to do this for about another 18 months, possibly 2 years. Nobody really knows, to be quite honest with you. And as I say, it's not absolutely definite, but if you have a loss this year and you paid corporation tax in the last few years, then you need to talk to your accountant and ask them about carryback losses, because it could be really, really crucial. Losses on bad debts. So if your business loses money to a customer who won't or can't pay, whatever it happens to be, or an employee who quit after receiving an advance in wages, or loans to clients, or anything like that, and the business is now not able to collect that money, you should be able to claim that amount as a tax deduction. So you'll have to prove that you've taken reasonable steps to collect this money, and that you've been unable to do so. So you have to prove any emails that you've had to send out, or if you've had to get a solicitor to write a 7-day letter or anything like that, you'll have to show proof if you're ever asked by HMRC to do so. You have to be very careful if you're VAT registered, really, really careful, because there are certain rules as far as bad debts are concerned. Another key one that a lot of people don't put through, or don't think that they can, is education and training. Now, it's a really good idea to invest in your employees. In fact, it's absolutely crucial in my eyes. You should be able to deduct the cost of doing that anyhow, but many business owners actually overlook the fact that educating and training their employees is actually a deductible expense. Now, bear in mind that if you are a director of your company and you're employed by your company, that includes you as well. If you are paying for training either for yourself or for your employee, or if you're self-employed for yourself, say you're training to be a business coach, for instance, but you've always run an electrician's company, then that is not allowable, because it's not a continual thing which is going to build up the business that you've got. If you are, I'm an accountant, obviously. I am now paying for the training to carry on doing the next stage of the Profit First, which is costing me, and that is an allowable cost, because it is increasing my my learnings as far as being an accountant is concerned. But if I was training to be a plumber, then it would not be. Okay, so that's really, really key. But again, keep a really careful record of all spending that you've got. This is the most important thing. Keep a record. If you are using a cloud accounting system, for a start, please use a cloud accounting system. Attach a copy of that invoice, bill, receipt, whatever you've got, to that payment that you're making. If you're VAT registered, then you have to anyhow by law. But if you're not VAT registered, do it anyhow, because then you've got a digital receipt. If ever you had your investigation from HMRC, and I know I keep banging on and on and on about this, but they're so random. Nobody knows who's going to be called next, and nobody knows for what reason or why they're going to even think about doing it. But if you have got everything to hand, you are less likely to go into a complete flat panic, which most people probably would do as far as HMRC is concerned. And it's really important, really important to make sure that you keep your receipts. So attach them if you've got a cloud accounting system. Use Receipt Bank or Dext or whatever the heck it's called, or auto entry, or you can use HubDoc with which is free with Xero. I personally don't like HubDoc. I'd rather use auto entry, but that's completely up to you. Kate's asking a question here. How about if you're branching out to a new area under the umbrella of your business? Can you put training down, then have a trading as sub-business? It depends if you're a limited or sole trader. If you're a limited company, then you don't need to put it down. And it sort of also depends on how far, what the distance is between your current business and what you're doing, what your new training, the new area that you're doing is. So again, it does totally depend on what that particular area is. So summary is, we all want a smaller tax bill, don't we? Please. So if you can think about these overlooked deductions or potential deductions, then hopefully you will be paying less than you need to be. But I'm going to say it again, keep very careful track of every single receipt that you've got. If you don't need it, your accountant will get rid of it. If you do need it, then it's there already. Perfect, that's fine. And again, if you do get an investigation from HMRC, they now can have access to your Xero account, so therefore they can see every single receipt that you've got in there. And if you're VAT registered and you're not attaching your receipts to your cloud accounting system, then please start, because it's now illegal not to do that. So anybody wants any help with as far as accounts, tax, Profit First, please give me a call, contact me, email me, look on my website, whatever you like to do. I'm always here to help if anybody wants any help. And I will see you next week.